Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at RCAT Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to imagine a scenario right now.
Okay.
A company goes out into the market, right? And they report a revenue increase. But it's not, a 20% jump. It's not even a 200% jump. They report a revenue increase of nearly 2,000%.
Which is just an absolutely massive number.
Exactly. I mean, 2,000%. They completely shatter Wall Street estimates. So you would think the market would just be throwing a parade for this stock.
Oh, yeah. You'd expect it to go absolutely parabolic.
Right. But instead, the stock violently tanks. It just crashes. And that is the astonishing contradiction that we are unpacking today for you regarding RCAT Holdings, specifically their recent fourth quarter fiscal 2025 performance.
Yeah, and it perfectly illustrates, just how complex the market can actually be when you're evaluating growth versus profitability. Because, on the surface, those revenue numbers you mentioned, they're just staggering.
Completely staggering.
Right, and in the defense technology sector, scaling at that velocity usually implies that a company has struck a major nerve in terms of product market fit.
Yeah, so let's actually put the exact numbers on the table here so you can really see the scale of this earnings paradox.
Let's do it.
So for the fourth quarter of fiscal 2025, RCAT reported revenue of $26.2 million. And that is that nearly 2,000% year-over-year increase we just mentioned.
Which is wild.
It really is, especially because Wall Street was sitting there, modeling for about $23.92 million.
So they cleared it easily.
With room to spare. And then if you look at their full fiscal year 2025, revenue hit $40.7 million. That's up 161% from the prior year.
Right.
Those are top-line numbers that usually send institutional buyers into an absolute frenzy.
Yeah, they do. Because when you see a defense tech firm pull off a 2,000% quarterly revenue jump, you are witnessing that exact moment a company transitions.
From like a concept to a reality.
Exactly. From a speculative research concept into a heavily contracted vendor. There are moving units out the door at a blistering pace. But as you said, the parade got rained on.
Yeah, it really did.
Because the market looked at the bottom line.
Right. So here is the catch. They missed their earnings per share estimates. Wall Street modeled a loss of 14 cents per share, but RCAT came in with a loss of 17 cents per share.
That's just a 3-cent difference.
Yeah, an extra 3 cents of loss per share. And the market just, hyper fixated on that miss. It kind of reminds me of, think about a massive summer blockbuster.
Okay.
A studio releases this huge superhero film that breaks all the box office records. Theaters are packed. The top-line gross is totally unprecedented.
Right. Everyone's going to see it.
Exactly. But behind the scenes, the studio went so incredibly far over budget on, special effects, reshoots, massive marketing campaigns. So technically, they actually lost money on the film that quarter. And that's exactly what this feels like.
That's a really good analogy, actually. The box office is the revenue, but the EPS is what's left over after you pay for all that CGI and marketing.
Exactly.
And in RCAT's case, that massive budget overrun, so to speak, is their aggressive scaling and really heavy research and development investments.
Which they have to do, right?
I absolutely have to. This EPS divergence isn't some sort of operational failure. It's not a situation where their products are flawed or, they're slashing prices just to move dead inventory.
Right.
They are spending heavily to capture and maintain a very specific high-demand niche in the defense tech space. When you are a micro-cap defense company trying to lock in government market share, you just have to invest heavily up front.
You have to build the infrastructure.
Right, exactly,
Yeah.
to fulfill those massive contracts.
And we are actually seeing some early indicators that this heavy investment phase is starting to streamline a bit because their gross margins came in at 4.2% for the fourth quarter.
Right.
Now, you might be thinking, 4.2% sounds razor thin. Like if you are comparing it to a software company, that's terrible.
Oh, yeah, software margins are way higher.
But in this specific context, making physical defense hardware, that 4.2% actually represents an 85% year-over-year improvement.
Wow, 85%.
Yeah. It was down sequentially from the previous quarter. Management attributed that to the specific product mix they sold. But the yearly trend clearly shows the underlying manufacturing mechanics are getting much more efficient.
And that sequential dip, I mean, that's just normal noise in hardware sales. Sometimes you sell more of those high-margin software integrations, and sometimes you just sell the base hardware.
Which drags it down.
Exactly. It drags the blended margin down for a few months.
Yeah.
But that 85% year-over-year improvement, that is the real signal through the noise. They are figuring out how to build these systems cheaper at scale.
Right.
But still, that heavy R&D spend and the EPS miss, it raises an immediate, undeniable question about their runway.
It really does. Because if they are scaling this aggressively and burning cash on R&D, like that movie studio burning cash on special effects, how on earth are they paying for all of this without hitting a wall?
Yeah, you can't run on fumes.
Right. The math says you can't sustain 2,000% growth on $0. And that brings us to their balance sheet transformation.
And this is where the narrative shifts completely. From like a fragile growth play to something seriously formidable. Because if you look back at RCAT, at the end of fiscal 2024, they were sitting on just $9.2 million in cash.
Just $9 million.
Just $9.2 million. And in the defense sector, where sales cycles are just notoriously long, contract approvals drag on for months and manufacturing is highly capital intensive.
Oh, yeah.
$9 million is barely enough to keep the lights on. It was a position of extreme vulnerability.
Right. At $9 million, the market is literally just waiting for the other shoe to drop. Investors know management is going to have to print more shares just to survive.
Which dilutes everyone else's equity.
Exactly. But flash forward to the end of fiscal 2025. They ended the year with $167.9 million in cash.
Just a staggering difference.
They turned a massive weakness into an absolute fortress. I mean, that is a jaw-dropping leap in liquidity.
It really is. And having almost $168 million in the bank, it fundamentally alters how institutions view the stock. It protects investors from those near-term dilution risks that typically just plague microcap tech stocks.
Because they don't have to panic raise money.
Exactly. With that kind of capital on hand, the immediate fear of a secondary offering is just completely removed. They have the financial runway to execute their strategy, absorb the R&D costs we talked about, and just wait out those long government procurement cycles without sweating payroll.
Yeah, I totally see the power of that cash position. But, and I have to push back here on another number that's jumping off their balance sheet.
Okay, let's hear it.
Because alongside that massive cash pile, their inventory levels completely ballooned. They went from $13.6 million in inventory to $30.4 million. They more than doubled it.
They did.
Now, if I'm looking at a retail stock, right, and I see inventory doubling while earnings miss, that is a glaring red flag.
Oh, absolutely.
That usually means unsold goods are just collecting dust in a warehouse somewhere. So my question is, are they just hoarding drone parts, or is there a guaranteed buyer for all this gear?
Yeah, that's a completely fair question. If this were a consumer electronics company, doubling inventory would absolutely be a massive red flag.
Right.
But we have to contextualize this within the defense sector's unique mechanics. The defense industry does not build $30 million worth of highly specialized tactical military hardware on speculation.
So they aren't just hoping a random buyer shows up.
Not at all. In this sector, a massive inventory buildup signals management's high confidence in fulfilling upcoming specific contract demands.
Okay, so they are essentially pre-building to meet an order they know is coming down the pipeline.
Precisely. You cannot win a massive government contract and then turn around and say, great, thanks. Give us 18 months to figure out our supply chain and source the microchips.
Yeah, the military's not going to wait around for that.
Exactly. They expect delivery. So that $30.4 million in inventory is essentially coiled spring tension. It is capital that has been deployed to ensure they can immediately fulfill contracts the moment they are awarded.
Right.
It's basically a prerequisite for playing in the major leagues of defense procurement.
Okay, that reframes the inventory completely for me. But I want to know, what exactly is in that $30.4 million stockpile? Because the military drone market is pretty crowded with competitors. What is RCAT actually building that gives them a real competitive advantage?
Well, their core moat is built on what they call their family of systems approach. So they are a trusted, strictly U.S.-based defense tech provider operating through subsidiaries like Teal drones and FlightWave Aerospace.
And being U.S.-based is a big deal right now.
It's massive. It isn't just a marketing slogan. It is an absolute non-negotiable requirement for government contracts right now.
Because of the security risks with foreign tech.
Exactly. The intense security concerns regarding foreign-made hardware and software vulnerabilities.
Right. And the anchor of this whole system is the Black Widow, right? This is their proprietary small unmanned aircraft system, the SUAS, specifically engineered for tactical operations.
Yeah, the Black Widow is their heavy hitter in the air. It's designed for really rigorous battlefield environments. But the thing is, their strategy isn't just about owning the sky.
What else are they doing?
They are aggressively expanding into maritime domains with a program called Blue Ops.
Oh, wow.
Yeah, and what's crucial here is how they are connecting these domains through the RCAT Futures Initiative. This initiative is entirely focused on integrating third-party autonomous systems directly onto their existing platforms.
You know, I actually saw the prime example of this recently. RCAT announced the integration of the Bullfrog counter-drone system onto their Blue Ops uncrewed surface vessels. And if you just think about what that actually looks like in the field, you have an autonomous drone boat just patrolling the water, carrying a sophisticated system specifically designed to detect and take out enemy drones in the airspace above it.
It's incredible tech.
It really is, and the market recognized the value of that immediately. I mean, shares shot up nearly 10% just on that specific integration announcement. It proves they aren't just selling a remote-controlled airplane, they are building a comprehensive operational platform.
And that platform architecture is exactly what creates incredible stickiness with government clients. When you take third-party tech, like the Bullfrog, and you seamlessly weave it into your own maritime hardware, you are basically embedding yourself into the military's operational nervous system.
You know, it's remarkably similar to a popular smartphone ecosystem.
Now, that's a good way to look at it.
Right. You buy the base phone and it works fine, but then you buy the wireless earbuds, the smartwatch, you integrate the proprietary software, you store everything on their cloud. And once you are fully in that ecosystem, the switching costs are massive. So true.
If you want to change to a competitor's phone, you have to replace all your accessories, migrate all your data, learn a whole new operating system. RCAT is applying that exact same psychological and logistical lock-in to military hardware.
Exactly.
Once the military adopts the base platform, they are highly incentivized to keep buying compatible hardware and software integrations from RCAT's family of systems.
And that network effect makes their moat incredibly resilient against newer, potentially cheaper competitors. I mean, think about it. A government procurement officer might look at a competitor's drone and realize that even if it flies a little faster, it doesn't integrate natively with their Blue Ops maritime vessels.
Right, it doesn't talk to the rest of the fleet.
Right. It can't communicate with the Bullfrog counter-drone systems they just bought, and their pilots aren't trained on the competitor's software interface. The logistical friction to switch vendors is just too high. So let's recap where we are. We have a company predicting 2,000% revenue growth. They're sitting on a massive $167.9 million cash fortress, and they're leveraging an incredibly sticky product ecosystem.
Yeah, the fundamentals look incredible.
Which brings us right back to the core contradiction. If the fundamentals are this robust, why did the stock violently crash after the earnings report?
We have to look at the market psychology here and how Wall Street digested this data.
Yeah, we do. So following the March 19 earnings release, shares crashed 17.8%, and it was a brutal reaction to just a 3-cent EPS miss. But you really cannot analyze a single day's price action in a vacuum. You have to look at the momentum leading into the print.
Because if we zoom out, the chart looks completely different.
Completely different.
Prior to this earnings report, the stock had a one-year total shareholder return of 214.81%. It was on an absolute tear.
Yeah, massive gains.
Even just looking at the immediate 30 days prior to the report, the stock had surged 49.52%. It was just flying high on anticipation. And that aggressive run-up is exactly why the 17.8% drop looks less like a fundamental break in the company's thesis and more like a strategic technical shakeout.
A shakeout. Explain that.
Well, when a microcap stock runs up nearly 50% in a single month, you attract a massive influx of speculative traders. They're just hoping for a flawless blowout earnings report to trigger a short squeeze.
Oh, right.
These are your weak hands. So the moment the algorithmic trading systems detect a slight imperfection, like missing EPS estimates by a few pennies due to R&D scaling, those weak hands panic. They hit the sell button and cascade the price downward.
Okay, so it's essentially a psychological reset, just clearing out the speculative froth.
Exactly.
But I have to play devil's advocate here for you. If it's just a technical shakeout, aren't we risking catching a falling knife? How do you distinguish between a healthy reset and the beginning of a broader, sustained collapse?
That's the million-dollar question, right? And the answer is you look at what the institutional analysts and the smart money are doing while the retail traders are panicking. Take Needham analyst Austin Bolig as a prime indicator. Immediately after this earnings report, digesting the exact same EPS miss that caused the sell-off Needham maintain their buy rating.
Wow.
And more importantly, they actually raised their price target on RedCat from $16 to $20.
Now, an analyst raising a price target directly after a perceived earnings miss is a massive signal.
Huge signal.
It means they are actively looking past the short-term noise of the R&D burn and focusing entirely on the underlying top-line growth metrics and that $168 million cash position.
Furthermore, the volume dynamics and sentiment indicators during the drop really support the idea of institutional accumulation. There was a notable piece by a contrarian analyst on Seeking Alpha who essentially took the direct opposite view of the panicking retail market.
Oh, really? What was their take?
Their thesis was pretty straightforward. No formal guidance, a massive overreaction sell-off, so they loaded the truck.
They bought the dip.
Exactly. And this points to sophisticated buyers stepping in to accumulate shares at a discount. They recognize that the core growth thesis for RedCat remains entirely intact despite the quarterly bottom line miss.
Okay, so if the stock has reset, the weak hands are flushed out, institutions are potentially accumulating, and analysts are pushing their targets up to $20, what are the specific events on the horizon that could actually drive the price to that target?
We need to look at the catalysts.
Right. Let's lay out the forward-looking roadmap for you over the next 3 to 6 months. What are the bullish catalysts? And just as importantly, what is the bear case that could derail this entirely?
The first major bullish catalyst on the horizon is the Q1 fiscal 2026 earnings report. That's expected around June 2026. This is going to be a critical proving ground for the stock.
What are they going to be looking for?
Investors are going to be hyper-focused on two specific metrics. First, are those gross margins continuing to stabilize and improve as manufacturing scales? And crucially, is that $30.4 million in coiled spring inventory actively converting into closed, revenue-generating sales?
Yeah, we really need to see that inventory physically move out the warehouse doors and turn into actual cash flow.
Exactly.
And a massive driver for that conversion is tied to the second major catalyst, the SRR program.
Yes, the SRR.
This stands for the Short Range Reconnaissance Program. It is a major U.S. Army initiative designed to equip individual soldiers with small, rucksack portable drones. The doctrine of warfare is changing, and the military wants these tactical capabilities deployed right at the squad level.
And RedCat is deeply involved in the selection process for this program. If we get positive updates or an official contract selection announcement in the coming months, that would serve as a massive fundamental validation of their entire tactical strategy.
Because winning an SRR contract wouldn't just be a revenue boost.
No, it would cement their family of systems into the permanent infrastructure of the U.S. Army. And hovering above all of these specific catalysts is the broader macro backdrop.
The geopolitical situation.
Right. We have to view the current geopolitical instability, specifically the ongoing context surrounding Ukraine and Iran, strictly as macroeconomic drivers for global defense spending.
Because drones have proven to be the defining tactical asset in these modern conflicts.
Absolutely. They have fundamentally altered how reconnaissance and strikes are conducted. As a direct result, defense budgets worldwide are rapidly reallocating heavy capital toward uncrewed, autonomous systems.
And for a company positioned exactly where RedCat is, this geopolitical reality serves as a powerful, sustained macro tailwind.
It really does.
It's the stark reality of the defense sector. Global instability directly fuels the demand vectors for these products, but we have to look at the realities of the bear case.
We always have to look at the risks.
So what keeps the skeptics up at night when evaluating RedCat?
The primary risk is simple and unavoidable. The company still bleeds cash operationally. Yes, they've secured a phenomenal $167.9 million war chest. But if you are losing money on the operational side, or if your operating expenses consistently outpace your gross profit as you scale,
that cash cushion can disappear.
it can erode much faster than investors anticipate.
Yeah.
If revenue growth stalls for any reason, say a delayed SRR contract announcement or some kind of supply chain bottleneck, that cash burn transforms from a strategic investment into a very loud, very dangerous ticking clock.
And that operational reality feeds directly into the second major risk, which is their valuation premium. Because RedCat is currently operating with a market cap of over $2 billion, all while carrying negative GAAP earnings.
Right.
And when you are valued at $2 billion without generating a bottom line profit, your stock is priced for absolute perfection.
It is. When a microcap stock is priced for perfection, the market leaves zero margin for error. Any stumble, a missed quarter, a lost government contract, or even just guidance that suggests slower than expected growth could cause severe multiple compression.
And that's painful when it happens.
Very painful. That happens when the market collectively decides the company simply isn't worth the massive premium it was previously paying, and the stock price recalibrates downward, often violently. High-growth defense stocks are inherently volatile for this exact reason.
They're in that transition phase.
Exactly. They are navigating a precarious transition phase, trying to move from a speculative, narrative-driven concept to a harsh, revenue-generating reality.
Okay, so synthesizing all these data points into a final investment thesis for you. We are looking at a fundamentally strong company in navigating execution risks. We're giving this a 7 out of 10 bullish score.
7 out of 10.
This sets up as a classic buy-the-dip swing trade. You are looking at roughly a 6-month hold utilizing this post-earnings, 17.8% sell-off as your entry point. The target is that $20 mark set by Needham.
Right.
And the strategic game plan is to hold through the upcoming June earnings report and wait for those critical SRR program wins to actually materialize and drive the narrative.
It is a really calculated strategy that weighs the undeniable 2,000% top-line growth and the newly fortified balance sheet against the stark realities of their operational cash burn. The market has basically handed investors a technical reset.
A second chance to get in.
Exactly. And the ultimate question over the next 6 months is whether RCAT can successfully convert their massive inventory stockpile and their ecosystem lock-in into undeniable bottom-line profitability before the market's patience runs out.
The tension between their rapid technological scaling and Wall Street's relentless demand for bottom-line results, it's just going to be fascinating to watch unfold.
It really will be. And if we step back and connect this to the broader picture of the defense industry, it leaves you with one final critical question to ponder.
What's that?
We know that RCAT relies heavily on these massive macro geopolitical tensions to drive their current explosive drone demand.
Yeah.
But what happens to their vaunted ecosystem lock-in if global defense budgets suddenly shrink in the future? Can their highly specialized tactical technology pivot seamlessly to commercial or industrial uses, or are they entirely permanently bound to the battlefield?
That is the ultimate test of their long-term resilience. Thank you so much for joining us for this analysis. We'll catch you next time as we continue to track the catalysts shaping the market.